Hey guys, welcome back to Smart Trader. This is Diaspol and thank you so much for all your likes, comment, share and subscribe to my channel. If you're a new viewer, definitely go to our channel and watch all these videos. And if you're liking these videos, then you can hit the subscribe button to be a part of the Smart Trader family. For the ones who want additional services, always WhatsApp 7892652481 is our number. And for the ones who wants to be part of my secret Telegram channel, you can open your account either in Zerodha, Upstock, Angel Broking or Alice Blue. So without wasting time, let's start off with today's topic. So today's video is regarding the SEBI circular which was rolled out on July 20th. So if you want to download this PDF, you can go to the SEBI website and download the circular of July 20th regarding the margin one. So few of them would have heard about this, few would have not heard about this, a few may not understand this, so that I thought I'll just make a video because a lot of people have asked in the comments, and also we didn't have time to do this because of the account hack. Alright, so what is this margin? Okay, what is this margin rule by SEBI and how is it calculated and what is the impact on us, and all that we will discuss in this particular video. Alright, so SEBI circular, this is a circular PDF which I have downloaded. Even you can download and go through if you want to read all that, but we will discuss in a basic terms, very simple summary. Okay, there are so many things discussed over here. Okay, so this is basically the leverage what you get. For few people who don't know, we used to get a leverage. For example, you are going to buy, let's say, a equity stock. So you have CNC. So for buying in CNC, you want 674 rupees of Tech Mahindra. Whereas in MIS, you need how much? You can see here, 73 rupees only to buy Tech Mahindra one quantity. Same way, if you go for cover order, it may reduce more down. So the margin required was less. You used to get 5 times, 10 times, 15 times, few brokers to give 20 times and so on. So now, same way in future also you had the same thing. Now, for example, you need to buy a one lot of Tech Mahindra futures derivatives. You need 2 lakh rupees, right? So if you see a 2 lakh required, but if you go for MIS, same thing for intraday with leverage, you can buy for 63,000, right? So normal order also you can do intraday. You can buy with your full money and sell the same day. It will become intraday, or else you can hold it for tomorrow also. But MIS, because you're taking extra leverage, see, extra leverage, so you cannot hold for tomorrow. You need to pay back the broker. So therefore you had to square off the same day. That's the only difference. So both can be for intraday only, just that you don't get extra money in normal. I'm just giving an example. Even we will talk about the margin about that also. So what is this circular telling in very simple words? This circle is telling that from August onwards, that is 2020, that is this August, whatever the day is going to start, this month, August onwards, no leverage. For basically that extra money what you used to get 10 times, 15 times, no more leverage. So for example, if you want to buy futures of Tech Mahindra, so you had to pay how much? 2 lakh rupees. I know the money required is more, but you used to have a margin, right? 2 lakh rupees is required to buy this Tech Mahindra. So therefore now to do in intraday, whatever the MIS or cover order, nothing is there. Okay, the orders will have the same margin. You have to pay 2 lakh itself to do, even though you're doing intraday, you're holding tomorrow. Doesn't matter, for your future, you will get the same money only. And so it will be like just same. If you want buy a normal order, same money, you can sell today as an intraday, or hold it for tomorrow, day after tomorrow, and sell after 2-3 days. So if I go to the margin calculator of Zerodha, you can just Google it. So if I go to equity futures, so you could have seen that normal margin needs 43%, 21% of ACC, 22% of money you need in your account. Not 100%, just 22% you need to carry forward. Normal order what I showed you. So this is normal order. So this is the normal order which I showed you in equity or equity futures. All right. So if I go to FNO, you see something called span and exposure margin. This is what has been calculated. So for example, if I calculated for ACC August future, let's say I'm just adding it. You see this? You need span of 1,33,000 and exposure margin of 25,000. So you need totally 1,58,000 to buy one lot of ACC. Okay. So that was your normal order till now. So you can pay so much of money and hold it tomorrow, day after tomorrow, till expiry you can hold it. But going forward in intraday also, you will not get any extra money. No cover order, no bracket order, no extra leverage in those orders. Yes, orders will be there, but no extra money. The leverage, additional leverage. So you see this with extra leverage. This is without additional leverage. So from now on, in this also there won't be leverage. Whatever you're paying for normal order in your future, same money you have to pay in MIS or whatever leverage. So no leverage from now on. So SEBI in considering the risk management, SEBI has instructed all these brokers like Zerodha, Upstock, whichever broker, trading brokers we have, they have instructed them to take this money from the client. When you put a trade only, you should have so much money, or else we can't put a trade, right? So take this money in before only, or else they'll be getting penalty. The broker only will get the penalty if you don't collect the right margin. Anyways, the penalty dates are different for them, but anyways, broker will start off cutting down this leverage now only from us. So talking about the equity, so this was a future example, right? Derivative. Now talking about the equity, if you want to buy Tech Mahindra, let's say this is an equity, right? Tech Mahindra. So if you want to buy this, CNC you need 674 and MIS you wanted only how much? 73 rupees. But from now onwards, you need to hold something like, it's mentioned here, okay? VAR margins and ELM margins. So what are these margins? That we can go to NSE India, just open any random stock, Dr. Reddy, okay. So if you see here somewhere we have over here, right, okay, value at risk. So this is the VAR, so that's the full form, value at risk, and then you have ELM, some extreme loss margin or something. So overall you see a rough margin rate for this stock is 16%. So you should hold 16% margin to buy Dr. Reddy. So maybe Reliance will have some percentage. Some stocks need 50% of the money. So for equity, for going onwards, you should have these two things, VAR margins and ELM. For futures, you should have span and exposure margin. Anyways, there is already a calculator for futures, so you can calculate. For equity, I don't know how they will come up. They may create it, I'm not sure. But anyways, rough calculation I'm giving. These numbers can change up and down. It depends on the broker how they calculate. But roughly you see the 16% money you need for Dr. Reddy. So Dr. Reddy is like around 5 to 6, 7 times you're getting. If you calculate, you'll get to know 6 to 7 times margin only. So going forward in MIS, you will get 6 to 7 times of margin for intraday. CNC, you need to have 100% of the money. But in terms of MIS, you need 16% for Dr. Reddy. That means if you want to buy 1 lakh value, you need to pay at least 16,000 for intraday. So around 6 to 7 times only you are getting. So before we used to get 10 times, 15 times, 20 times, right? Cover order and all those other brokers used to give more and more times, right? But now it has reduced. Let's take an example of any other broker to see the percentage difference. So let's see the VAR and ELM. So see, this broker needs 23%. So depending on the stock performance and their own risk, I think they are keeping certain margin rate. So 23%. So for example, if you want to buy 1 lakh of value of shares, you need to pay 23,000. So you should hold so much of margin to buy 1 lakh value in intraday. Okay, so that is the only difference. So it's not that 100% your leverage is gone. You're getting that 4-5% depending on certain brokers, certain stocks. Few stocks have 2 times, few stocks have 5 times. Like Dr. Reddy is a very good stock. So you see there is 6-7 times margin. So equity members will get around 5 to 6 times, 2-3 times based on the stock. They will continue to get some margin in equity trading. CNC, like you should have full money as always. But in terms of futures, if you see your normal margin required, used to normally get normal margin, used to get some 3 times, 4 times money used to get. But intraday 15-20 times is gone. So you have to have the same money as your normal to do futures and options and all those. So therefore in derivative markets, you do buy today, sell today only, or you're going to hold it tomorrow or till 1 month also till expiry, you should have the same money. So going forward, no extra money given by the broker. Now depends on the broker, because penalty is going to come from, I think there are different dates over here. So they have mentioned some dates below here. Now the brokers have to break their head on this. We don't have to break as a customer. But if you see here, they have different phases over here. So they're not going to put penalty on a broker directly. So they're going to have phase 1, phase 2, phase 3, phase 4. But August 2021, it should be 100%. Even if you don't have margin, broker will have penalty properly. So I hope you guys understood the idea. In equity, the margin, the leverage is going to reduce in intraday. It's going to reach to 3 times, 4 times, 5 times. Or I think if you go to our old website of futures, Zerodha equity itself, I think that 5 times, 3 times, 4 times, I think somewhere it will come closer to this number, or maybe it may reduce also. I'm not sure. Maybe not 10 times, maybe somewhere lesser. So depending on the stock, you may get 5 times, 4 times, like I showed you here. They need to collect this money, right? This percentage they need to collect. So that is mandatory. So it's going to reduce to here. So maybe they may update their brokerage calculators or your margin calculator. Different brokers have different calculation. So they will calculate and let you guys know. So what is my take on this? So my take on this is, see, I understand the volume in the market is going to reduce. The brokerage firms who used to make some money, or who used to invest their money on technology and all, maybe their revenue will go down. That is one way. So definitely it will hurt a lot of intraday traders who used to take leverage. But in another point of view, if you see, a lot of beginners, even when I started trading, because of too much of leverage and less of knowledge, I used to make big losses, right? But now knowledge is increasing, I'm taking less leverage, if you see. So leverage is something which will spoil a lot of investors. They will quickly exit the market without even learning the market. But if you reduce the leverage, I'm sure they will take more time to learn the market. So we can take it as in a positive way. Let's take everything as in a positive way. And by this, I'm sure in a long term, if you see, a lot of people stay in the market for a long time. For companies like Zerodha Upstox, maybe initially the volume will drop, or the liquidity what we see in stocks may drop right now. But I'm sure because of this, a lot of people will stay in the market for a long time. So in a longer run, this is going to be a beneficial for customers, for us, safety of investor, but also from the broker or the company's point of view also. Initially they may have some disadvantage of less revenue and all those, less trades by people or less quantities taken by people. But later on, I'm sure more number of people, active traders will be more, rather than just doing few trades and exiting. I'm sure the people will stay long in the market. So let's take it in positive. So very simple, don't feel bad or something that leverage is gone. Your leverage is going to be harmful also, more profit and more losses also. It's okay, you're getting 3 times, 4 times also, no problem. It is good for your own trading. So that was my understanding. Do let me know if you know more about this particular concept, or about this particular, you have a different thought process. Do let me know in the comment section. I just shared my opinion and my thought about this. So do let me know in the comment section. See you guys in my next video. Till then, take care. Bye bye.